The following is a sponsored program paid for by First Alliance Credit Union. Welcome to Good Money Moves, featuring Jenna Taubel from First Alliance Credit Union and Andy Brownell. Here's Andy Brownell on Rochester's News Talk, 1340 KROC AM and 96.9 FM.
Welcome to Good Money Moves. I'm Andy Brownell, along with Jenna Taubel, AVP of Marketing with First Alliance Credit Union. Hi, Jenna.
Hello.
We have a guest today.
We do. Yes, I brought in Jordan from our lending team today to help us flush out today's topic. But before we get into that, I want to hand it over to Jordan really quick and let him introduce himself a little bit, share a little bit more about his role at the credit union.
Sure. Yeah. So as Jenna said, my name is Jordan, and I am the loan portfolio manager here at First Alliance Credit Union. I started in 2019 as a lender, and then worked my way into underwriting, became the lead of our underwriting team, and then now as the portfolio manager, I oversee our underwriting team, not only for consumer loans, but also business loans, and just keep an eye on how the loan portfolio is performing and make any recommendations to see if there's any ways we can improve it or what we can do for growth. So really like this new role. Just started in March of this year, actually, as the loan portfolio manager.
Fantastic. Sounds like you're pretty busy.
Yeah.
So
days fly by, though. I don't mind that.
All right. So last week on Good Money Moves, we I guess we navigated through what is PMI on a mortgage.
Mm-hmm.
What's the topic this week, Jenna, on Good Money Moves?
Yeah, so today we're going to be talking about something that I think is really important for everyone who has a credit card to understand. We talk a lot about using credit cards, but I want to dig a little bit deeper today into what happens if you have a credit card, but you don't use it frequently. I think a lot of people think that not using their card is going to have minimal impact on their credit score, but in reality, it can actually affect your credit score in some surprising ways. So I brought in Jordan to help kind of break down what that impact on your credit card inactivity looks like, and what issuers might do if your account sits idle for a long time, and how you can kind of keep your credit card active without going into active debt. Plus, we're going to touch on how to build a good credit from scratch for those who are just getting started. Lots to cover today.
Yeah, great topic, and especially the inactive credit card part of it, because I've had questions about that myself.
Yeah.
So I guess I'll direct this at Jordan. A lot of people have credit cards. I know our household is part of this club that we barely use, or they're just there for emergencies. So I guess to start with, what's the big deal about continuing on not using them?
Yeah, so one consequence of not using your card for an extended period, it can range anywhere from 6 months to a year. It kind of depends on who the credit card issuing company is, or the financial institution that gave there, but they may lower your credit limit or maybe even close the account entirely because of the inactivity, and that can really hurt your score. I think of a couple examples of some people where the only open trade line they had was a credit card, and there was actually no activity, and they closed it. And after 6 months of no activity, they lost their credit score. It went to no score, even though they had a bunch of information on their credit report. So it's important to show activity. Otherwise, you could, either hurt your score by the lower credit limit, or lose your score altogether and have to start from scratch, essentially.
Do these credit card issuers give you any warning, Jordan, that, hey, you haven't used our card for a long time. If you don't, we may close it?
Yeah, they don't have an obligation to do that. So it may kind of surprise you if 1 month if you use our Savvy Money tool to monitor your credit score, you may see all of a sudden a decrease in your score and be like, well, what's that about? And then you'll reactively realize that you have a closed credit card from whoever it may be.
So these credit card issuers, obviously, then it's not common practice to allow accounts just to sit around.
Yeah, no, if there's no activity on it, and again, it's all varies from one place to the next, but they again may lower your limit or close it out and just not really give you a whole lot of notice, and if any at all, and it can really hurt your score if they close it out because the primary reason why that drops is because your credit utilization ratio is going to depending on what other cards you have, may actually increase. And the higher utilization you have, the lower your score may be. But one rule of thumb that we generally see, and it's not down to an exact science, but approximately for every percentage of utilization that you increase or decrease, your score will decrease or increase respectively, depending on how your utilization goes, or almost like point for point. So you use 1% more, your score will decrease 1%. So if it's your only card that gets closed out, you'll lose all your history, possibly up to 100 points if there's any other trade lines there.
I experienced this recently. I used a credit card to cover some major bills. I knew temporarily. I just put them on the card and then relatively quickly paid off that balance. It was more of a convenience than anything else, but that use of shrinking my utilization rate or increasing it, whatever way you want to look at it, almost immediately had an effect on my credit score. It was amazing. Even though within 30 days it was paid off. But so I can see how that could happen very, very quickly if you're not anticipating it. So I guess what would be the best way to avoid having this happen to you? Either have your credit score lowered or your account even closed completely.
Yeah, so really it's just using some minor recurring expenses. Like if you want to put a tank of gas on there once a month, or if you have Netflix or Hulu or something like that, then you put that on there, but just make sure you pay it off in full every month. One thing that I do with my credit card is I actually pay it off prior to the statement coming out, so that the balance that's reported to the bureau is little to nothing, depending on how they process the payments and things like that. By paying it off in full every month, you're not going to be racking up debt or paying interest, because if you pay your balance off in full every month, you won't pay interest. And then doing that will also help to keep your card active so that they don't close it out on you. You can set up automatic payments to make sure that you don't miss payments on that. Sometimes, especially if it's a card that you use sporadically, it's easy to forget that you may have even charged something on it. So if you have automatic payment on there, you don't have to worry about a late payment or anything like that impacting your score either.
I like the idea that if you have this card that's there perhaps just for emergencies, right? Mm-hmm. You mentioned Netflix or a streaming service, or maybe, I don't know, a newspaper, whatever it may be. Put that on that card and then right away do the automatic payment. So it runs on autopilot and you never have to worry about it, but you still get to have that activity on your card that won't affect your credit score, if I'm reading you correct.
Yep.
Perfect. All right. Well, let's take a quick break. We're talking about what happens if you don't use your credit card. And it sounds like it's not all good. Let's put it that way. We'll be back in a moment with more of Good Money Moves here on News Talk 1340, KROC AM and 96.9 FM.
Good Money Moves continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340, KROC AM and 96.9 FM. We're talking Good Money Moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk 1340 KROC AM and 96.9 FM.
Welcome back, everyone. It's Good Money Moves. Jenna and Jordan with First Alliance Credit Union with us this morning. We're talking about what happens if you don't use your credit card. So I guess now we should probably shift gears a little bit. Talk about folks who are just starting out and want to build credit from scratch.
Yeah.
I'll throw this at you, Jenna. What's the best way to get that started?
Yeah, that's a really good question. And kind of goes right along the lines of credit card usage, because a lot of times people start building their credit history with some kind of credit card. So building really good credit from scratch seems challenging if you're not familiar with kind of the basic steps of how to get there, but it is actually very doable. So I'm going to use an example. Let's talk about a recent young member that came in, and we're just going to call him John for purposes today. And he came in starting with no credit history, but he wanted to get started building a really strong credit foundation for himself. So First Alliance Credit Union got him set up with a secured credit card with a smaller limit, about $1,000, which is a great, those secure credit cards, we've talked about those before on the show. They're great options for somebody who's just starting out and wants to just dip their toe in the water with using credit cards. Secure credit cards are perfect for people who are new to credit because they do require kind of basically a security deposit, just in case you're unable to pay, you have that as that backup. So John put down that $1,000 to secure that $1,000 limit. Now, this card works just like a regular credit card, but the security deposit limits how much you can spend and helps, again, prevent you from accumulating too much debt that could get out of control. Plus, since those payment histories are reported to the credit bureaus just like any other type of credit card, it is a great option to start building that credit history in a really kind of careful manner. So this has been something we've talked about before on the show, is kind of these steps to take towards building credit using something like a secured credit card.
The one thing you mentioned it, but I just want to clarify. So there's not a little asterisk next to your credit report that says, oh, this is a little different than a regular credit card. It's treated the same as a regular credit card by the major credit reporting agencies.
Essentially, yes. I will let Jordan answer that question in full because I don't look at credit reports nearly as often as he does.
Yeah. No. So as an impact to your credit score, it does have the same impact to your score as an unsecured credit card. The only difference that you'll see on the credit report is that it's just going to say that it's a secured credit card rather than just a regular credit card, which is unsecured. But as for the coaching points that we're going to talk through today, everything will apply as for improving or rebuilding or establishing your credit.
So you'll end up having a normal credit score based upon your behaviors with this card.
Yes.
Okay. So you got John set up. He's got the secured card. I guess, Jenna, what are some of the important things that he should be keeping in mind now that he's out there using this card and trying to build his credit?
Yeah, great questions. I would say similar to some of the things that Jordan even mentioned earlier in the show here when we were before the break, the most important thing you can do is pay on time. Even one missed payment is going to hurt your score, but a series of missed payments are going to just compound on each other. So one thing that we recommend is set up automatic payments to your credit card to make sure that you don't miss that due date. And that's definitely something that we coached John to do when he came in and talked with our member advisors. So it's also really important to be careful with how much utilization you have on that card. And we've talked about this in previous episodes as well. You want to try to keep that utilization at 30% or less of that credit limit, which means on that $1,000 limit that John had on this secured card, no more than $300 should be sitting on that card, right? And that's the idea of keeping that credit utilization ratio a little bit lower, and that's really going to help build that stronger credit score over time. Because if you're constantly maxing out your credit limit, that is going to hurt your score. Even if you start to pay it off every month, there's still that opportunity that you're having that limit sit out there for too long. So keeping those balances low and paying it off in full is going to be really advantageous to helping build a positive credit score out the gate. And because what it does is it shows that you're managing credit really responsibly. So when he goes to maybe get a car loan next, he's got this really great history of paying on time and responsibly managing that limit, which again, it's going to help improve his score. And when he goes to get another lending product down the road, that's where all this work is going to pay off.
All that discipline.
Yeah. And just to piggyback off of that, I have seen individuals who apply. I mean, to get a credit score, if you've got no credit history, all it takes is 6 months worth of activity to get a score. And so what I've seen a few cases of this where people come and get a credit card, and we coach them and say, this is how you utilize it. This is what you should be doing. Use it, pay it off in full, keep your balance essentially next to nothing if possible. And they came back 6 or 7 months later with a score that was in the low to mid 700s.
Wow.
Yeah.
That's pretty incredible when you think. I wish I had this kind of coaching when I was a much younger person.
Yeah.
I remember the first credit card I had, and I went out and, as the old Fast Times at Ridgemont High movie line goes, I bought a rad set of tools and practically maxed it out. And ended up paying off those tools for many more years than I should have had to spend to pay for them. It was it was a learning experience for sure.
Yeah.
And it probably did not help my credit score at all.
No.
No.
No, it did not.
All right. We'll take another quick break and be right back with more Good Money Moves on News Talk 1340, KROC AM and 96.9 FM.
Good Money Moves continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340, KROC AM and 96.9 FM. We're talking Good Money Moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk 1340 KROC AM and 96.9 FM.
It is Good Money Moves. I'm Andy Brownell, Jenna, and Jordan from First Alliance Credit Union with us this morning. And we started out talking about, I guess, what happens when you don't use your credit card for a long period of time. Now we've shifted to building credit, especially for a person who doesn't have credit and wants to get rolling with all of the things in life that oftentimes require credit. I guess, Jordan, what are the common mistakes other than the one I just described before the break, maybe, that people make while trying to build credit?
Of course, there's a lot of information out there, and not all of it is the right way to do it. So what I've seen in some cases where, you have people who come to us for guidance and you can see what's on their credit report. Some of the common ones that we've seen would be, in general, if someone is carrying a balance from 1 month to the next. Some people think that carrying a balance from 1 month to the next does help to build credit. But having a balance on your credit card in and of itself will really not build your credit per se. It really just means that you're going to pay interest. And the higher balance, as we've kind of talked about, the higher balance that you have relative to your limit is going to make for a more negative impact on your credit report. One other mistake that we see is, sometimes people get guidance that like, oh yeah, just take out cards and it'll build your credit. But we've seen instances of people taking out like too many credit cards in a relatively short amount of time. And the reason why that can negatively impact your score is because from the credit bureau scoring model, it makes it look like you might be desperate or you need to rely on credit, which, from a risk indicator, the lower your score, the more risk there is associated with lending versus the higher the score. In theory, there's lower risk with lending. So with that logic being applied, if you're taking out a large number of cards in short order, again, it just looks like you're more of a risky borrower.
And I think that applies then to the utilization rate, right? That kind of that would give the lendor the same impression that all of a sudden you're racking up charges on this credit card.
Exactly. And then the last thing that we see is just missed payments. Even if you miss one, it can have pretty significant negative impact on your score. And like Jen had spoken about earlier, if you miss a couple like month over month, that's just going to hurt your score even more. So just staying on top of, when you charge something to your credit card, remembering that you did and making that payment on time. Sometimes it's easy to overlook, especially, if you kind of compounding some of these things that we had talked about all together, where if you've got a large number of cards, there's just that many more payments to manage. And, I think we all have enough bills in any given month, and
Yeah.
the more credit cards you take out, it's harder to keep track of,
And I imagine that that impact of a missed payment or a late payment is far more significant in the early stages of building your credit rather than someone who has, decades of credit history.
Yeah. On the flip side of that story I told a little bit ago, the person who followed our guidance and got a score of the low to mid 700s. On the flip side, if you've got someone who takes out a credit card and has maxed it out, even if you make your payments, I have seen scores in the low to mid 600s, just from maxing it out. So if you get that compounded with a late payment, your score right off the bat is probably going to be a very low 600 or a high 500, which is, you compound some of those pitfalls. It really makes for any future lending much more expensive with higher rates.
Absolutely. Okay. So Jenna, to wrap it up, maybe what are key things that we should remember about building that credit score and keeping the credit cards that we do have active so we don't get hurt by what happens when we let them sit in a drawer?
Yeah, well, I think the big things to keep in mind are exactly what Jordan mentioned at the beginning of the show, right? It's all about making sure that you're just using them even a little bit, even if you're just planning to have that credit card for emergencies. Like, using that tip, I thought was just a really smart idea. Like, put your Hulu or your Netflix on that card and then make sure that you just set up those automatic payments like we talked about to pay that off, so that you have just enough activity running through that card to keep it active, so that you don't end up in a situation where your card issuer, cancels that card on you and you don't know it. And then all of a sudden your credit score takes a huge hit right when you're about to go apply for a new auto loan or something like that. It's really important that you're just keeping tabs on your different credit accounts and your credit score. And there's a lot of really great ways to do that. Jordan mentioned earlier in the show too that, First Alliance has within our online and mobile banking, a free credit score tool where you can keep really close eye on your score, all the different credit lines that are impacting your score. And what I really like about that tool too is it gives you tips and things about why your score is where it is and how you might improve your specific score based on your credit mix. So, super amazing tool. If any of our members are listening and you haven't used it yet, check it out. It's free. If you're not a member yet, become a member so you can start using it to make good money moves.
Fantastic. And this, you can't stress the importance of this, because having that good credit score when you need it becomes crucial. When you're taking out that loan for that vehicle or seeking a mortgage, and all of a sudden somebody comes back at you and says, your credit score is not all that great. You probably need to work on this before you actually take out this loan. So fantastic information, Jenna, as always. And I have a feeling if we had the opportunity, we could expand on this for quite a bit more time.
Always.
So I'm going to ask you once again, particularly on building credit and things dealing with credit cards, where can I find out more information to make sure I am making good money moves?
Yeah, of course. I always encourage our listeners to visit our website at firstalliancecu.com. You can subscribe to our blog. We release new financial tips and advice regularly. You can listen to past episodes of this show at firstalliancecu.com/podcast or on krocnews.com. You can also subscribe to Good Money Moves on Apple Podcasts, YouTube Music, and Spotify. And as always, I encourage you to reach out to our team at First Alliance Credit Union so we can help you start making good money moves today.
That is First Alliance Credit Union, federally insured by NCUA and an equal housing lender. Jordan, thank you so much for spending time with us today and offering your expertise.
Of course. Yeah, I'm passionate about education. So the more people know, the more equipped they are to make sound financial decisions.
Perfect. And Jenna, thanks as always, and we'll talk again next week.
Absolutely.
It'll be another episode of Good Money Moves, and you'll find it right here on News Talk 1340, KROC AM, and 96.9 FM.